and it's happened. We said about a month ago that we expect reset inside the next 3 months, a real escalation. That has begun, and these relationships we're discussing is part of that. There is still always, so for counteracting the draconian and scariness of my message, there is always more time than you realize. Every action you take is better than no action. Even the best made plans will only parts work out, but often you can do more very well just out of that small segment that survives or wins out. So keep your mood up, keep your mentality up. This is the time for actually building wealth. Markets fall harder and faster in bear markets than they go up. Fortunes are made in much shorter times. Position well. This is what we're focusing on in our community, to help people build wealth, to position well for this, protect what they already have, and to secure as many freedoms in what could get a bit totalitarian and have optionality. And that's our core focus. And the shocker that happened last week that most people are not noticing, really critical shoe to drop, was actually the dollar weakening badly. This was a spiller, a thriller all the way from Manila, as we like to say, at the same time actually as the rates were going up. So even saying, we'll pay you more, keep your money in dollars, we'll pay you even more, people were running. That is a loss of faith.
The dollar is spiraling into oblivion, and gold knows it. As fiat currencies unravel and central banks scramble, gold has already launched into the stratosphere, brushing past $3,300 and climbing with every tremor in the system. But silver is stuck, frozen in the eye of the storm, trapped between bullish breakout and brutal suppression. The world is watching one metal soar while the other hesitates, and the question everyone's asking is why? Why is silver lagging behind, even as the economic foundations beneath our feet begin to crack? The answer isn't simple, it's systemic. Silver's fate isn't tied to everyday volatility. It's tied to something deeper, darker, and far more explosive. Because when the real collapse begins, when the final domino falls, it won't be gold that delivers the shock of the century, it'll be silver.
I always says it's about the debt market, Elijah. Everything starts with the debt market. It's the turbo juice for the run of liquidity into gold, and it is the base layer of our pyramid which is collapsing. And that 2020 was a seminal event. The late 2020 call, technically we made, there was a short and said that this was the end of the 40-year bull market in bonds, is the most significant call we made, bigger than oil, short to single digits and everything else. This is essentially the commencement of reset from 2020. You're already 4.5 years therein because it was late 2020. And now you're seeing the effects of essentially everything politically that's going on is as a result of the credit card having been cut. It's been downgraded from a black Amex to a blue Amex. You know, the bottomless limit has now got a hard limit, which is not nearly as deep as it used to be. And everything that has to do with doggy and efficiencies and Elon and a lot of, the expose of some corruption here and there and, making wins. It's all about trying to fit everything in. And you've got $9 trillion to roll before you spend your first dollar on your expenditure for the year, most of it locked in on multi-year contracts anyway, so the discretional spend is actually quite little. You're already pre-committed to that. That all needs funding and financing. And what's actually happened is we had this perverse event, and we warned of this, by the way. Once or twice, I think I showed you our diagrams we drew of the seesaw, with the fat guy at the bottom underwater, which was essentially the debt markets, and how the currency, the dollar, the skinny guy on the seesaw was high. And normally it moves like that. As rates get cut, the bond market goes up in value and the currency tends to go down. When the bond market was collapsing post-2020 into its lows, as many have had, we had a 45+% fall. What we had, it was actually a period of dollar strength, in a weird way, but we refer to it as an unhealthy strength because its partner was dying. It was the relatively strong because the other one was dead weight in a sense. And we also showed the British seesaw that actually broke when it had its mini pension crisis, which you might recall a number of years ago. And we said eventually you get to a stage where America does this, where actually there's so little faith as it was with Britain, they had the debt market collapse and the pound collapse simultaneously. Now, normally that doesn't happen because when your debt market is readjusting downwards, your rates are going up. So people want to hold deposits because they get paid more interest in your currency, so you get inflows. But when you have complete loss, like you had in that microcosm with the UK of confidence in their ability, they did an expansionary budget that was going to add to debt to stimulate the economy at the same time as there was all the inflationary effects of CV19 running through. What obviously happened is people said, no, we're not going to buy your debt. And you actually had the seesaw break where both halves fell below the waterline in that diagram. And we said the big day is when this starts to occur more often for America, and that is the breakdown of the system. And the shocker that happened last week that most people are not noticing, really critical shoe to drop, was actually the dollar weakening badly. This was a spiller, a thriller all the way from Manila, as we like to say.
Every financial panic has its safe haven, and right now, that haven is gold. As markets spiral from the chaos of unpredictable tariffs and looming central bank pivots, investors are flooding into gold like it's the only lifeboat left. The Federal Reserve is signaling a sharp reversal, with markets betting on up to 100 basis points in cuts this year. That alone has sent the US dollar into free fall, collapsing to levels not seen since 2022. But it's not just monetary policy triggering this gold rush, it's global uncertainty on every front. With every tariff announcement, every geopolitical flare-up, and every contradictory Fed message, gold grows stronger. It's feeding off the chaos, rising on the back of fear and distrust in fiat systems. And while gold has shattered records, silver remains behind the curtain, quiet, cautious, and oddly subdued. Despite climbing to nearly $33, silver still trails far behind its historical peaks. It's moving, yes, but not like gold. It's not the first responder. Silver's role in this drama is different and far more complicated, because unlike gold, silver needs more than fear to break free. It needs a spark that hasn't arrived yet, a spark that could ignite the most violent rally the metals market has ever seen.
Same time actually as the rates were going up. So even saying, we'll pay you more, keep your money in dollars, we'll pay you even more, people were running. That is a loss of faith. That's a complete different dynamic when people just say, we don't trust the system at all. Now, some of that will be with the backwards and forwards on tariffs. Everybody knows and seen all the memes, etc. 1 minute it's that, then it's this, and it turns back, and China just sits back and posts memes about the crazy Americans. And, you know, that didn't help with faith and confidence. Let's be honest, the lack of communication and clarity and direction and the backwards and forwards. But longer term, we will have more of this, and then it'll be more structurally based. We just don't think you can pay us back. And as a result, we don't want your currency or your debt instrument. And that's when both halves of the seesaw fall down. And that was something we predicted, said will start coming and occurring. And you had your first instance of that last week, where actually money was leaving the US. It's almost a flight capital. This tends to happen to emerging markets. They're relying on people in bringing in capital and buying their assets, etc. And then you get flight capital when they do politically something silly. People sell off the equities and the currency, and the money leaves the country. So you actually get stock market down and currency down simultaneously. So it's typically an emerging market currency phenomenon, Turkish lira, etc. South Africa, they would have had, during their political moments, many instances of fear chasing out. Now, America actually experienced an emerging market phenomenon, and that is a confidence question. That is a confidence question, and many will think, okay, who's the perp? Who sold us? And I saw some people, trying to handle Japan as doing it. The first go-to was China, but then no, it was Japan and all of it. They were selling treasuries and doing all of these things. It's actually no one clearly has been shown to be doing it on any great scale of a nation state. So it wasn't an attack vector of nation state. Some people are saying, well, maybe China was trying to give a little lesson to America about, how they've got them below the belt, in a painful place. But actually, there isn't even clear proof of that. What happens is institutions, even inside America, and institutions outside America, that can be hedge funds, that can be a lot of people going, whoa, we don't want this. We don't like what's going on here. There's uncertainty. Treasury departments for companies that are shipping goods and everything like that. So it wasn't even that America got ambushed by a nation. We can't say the Chinese did this to us or the Japanese did this to us. The Japanese still hold more than 1.1 trillion, going on almost 1.1 trillion in debt. I've been looking at the numbers, and the Chinese are holding 850 billion. And they haven't moved significantly apart from the loss of value as a result of the CV-19 collapse. So this is an unheralded shoe. America hasn't suffered such an indignity like an emerging market nation does in this. And this is the first instance of what I'm going to call a more common occurrence, unfortunately. So I'm being doomer here, I know it, but unfortunately that is the reason why. And for our gold and silver bugs, however, that is actually turbo juice for gold, because the biggest anti-dollar trade is selling your dollars to buy gold. And that's what you're seeing. It's a loss of confidence in the hegemon fiat and debt pair for the ultimate reserve currency, which is gold. So without taking you to any charts, that's how to answer that question.
The trade war is no longer a background threat. It's a live grenade rolling across the global economy. Every headline from Washington and Beijing sends shockwaves through the markets, and precious metals are right in the blast zone. One day, tariffs are paused to ease tensions. The next, they're reinstated at 145% with threats of even more to come. The result? Pure chaos. Gold is feeding off that chaos. But silver, once again, is caught in a tug of war. This isn't just a policy battle, it's an information war where clarity is a luxury no investor has. Markets can't plan, corporations can't predict, and currencies are swinging wildly with every tweet and press conference. In this kind of volatility, gold is a no-brainer for institutions. It's liquid, recognized, and free from industrial dependencies. But silver is dancing to a different rhythm. Yes, it's gaining momentum, climbing above $32.60 and pushing against resistance. But the market's hesitation is obvious. It's not enough to break through just yet. The tariff volatility is fueling demand, but not conviction. Traders want proof, something definitive. Until then, silver remains tethered, suspended in a holding pattern, waiting for the chaos to turn catastrophic, because only then will silver stop being a trade and start being a lifeline.
Yes, I would say it's the main, when I say the turbo juice for gold, I'm speaking quite specifically for gold first and foremost and predominantly. Silver, I will qualify a little bit later, but it's very specifically gold because it's big money. When you exit the dead markets, these are huge markets and it's very, very big money. So those will typically go into the high value denomination metal, and it's big money movers. It's hedge funds, central banks, big family offices working for very rich clients. I mean, not everyday millionaires, and probably centimillionaires and some billionaires that will be plowing money into the precious metal. So here we have the US 10-year, Elijah. And what actually happened, it was an incredible week last week, as you said in your question. We actually had a set of circumstances that the markets and the economical news generally was pretty soft, and people were feeling a bit nervous, and there was an expectation of recession. And we were here calling, listen, there's a potential head and shoulders here where rates could go down in a normal environment, which is a typical response to weak economic events. And we actually began that process. That's our neckline. It was at about 4.13. So we're looking at the 10-year yield. That's the yield. So down means bonds go up in value. Up means suddenly the bonds are losing value. And actually that triggered, and it started to move down, and everything was looking okay. We're softening. People are moving out of equities because obviously the stock market's been selling off for a while now. And they're moving into the normal stabilizer assets that is contrary typically to equities. When there's a fear in the equity markets, it normally does reasonably well. You don't get back all your losses in the equity market, but you get some, and you get a bit of yield. That's the typical thing that happens in a softening economy. You get that roll in. And then as you can see from here, we absolutely got monstered to the upside, which is a chronic devaluation in the debt. At the same time, in that red box, this is what was happening to the dollar index. Now, that's a macro chart that I want to show you, but here we are in terms of what it's been doing recently on the monthly and even on the weekly. We can put it there. This is what's happened to the dollar simultaneous to the yields going up. So higher rates are being offered. We'll pay you more to keep your money in dollars, and people are still rejecting the dollars for other failed currencies. What that was a degree of fear and divestment, I feel, and loss of trust, it has to be said, in America, in the financial system and its overall position, which will, as I say, be infuriated by and aggravated by tariffs.
Silver's biggest enemy right now isn't demand, it's hesitation. Despite punching through resistance at $32.60 and confirming a bullish breakout, it still feels like the market's holding its breath. Why? Because one critical level stands between silver and its next explosive move, $30. That's the line in the sand. It's not just a psychological barrier, it's a structural one. The bulls know it, the bears fear it, and the chart screams it. If silver falls below that mark, the entire narrative shifts. Suddenly, it's not a breakout. It's a fake out. It's a retreat. And that's why every price move is being scrutinized to the decimal. Traders aren't buying the dip, they're defending the floor. The $30 level is acting like a hinge between silver's long-term bull case and short-term panic. And right now, it's holding, but just barely. As the Federal Reserve flirts with policy reversals and markets teeter between inflation panic and deflation risk, silver is walking a tightrope. The fundamentals are there. The momentum is building, but the confidence, that's still in crisis mode. Until silver convincingly holds this ground and pushes beyond $33.30, it's trapped in what can only be described as crisis limbo, a market unsure whether to flee or to fight.
But this is not the main driver and cause. The debt-based collapse and the high level of debt is all the straw that's been piled on the camel. The last straw that got dropped on, and how people are panicking and trying to deal with that, renegotiate deals, try get more income, try reduce trade deficits with other nations, all of these, you're damned if you do and you're damned if you don't. These turn into the headline-making stories, but they're not the full story. What the full story is, we have a central banking cartel with commercial banks that literally since 1913 have run ever bigger boom and bust cycles, and I'll be showing you an amazing chart on that when we look at the Dow Jones in gold ounces. And they've got ever bigger, and the debt game is up. You can't afford the interest payments, and the debt game is up. So whoever took over, you could have had the smartest economist, you could have had Milton Keynes himself running American economic policy. It's literally, there's no good response. I refer to the 747 in the 70-degree angle, a meter or two away from the base of the massive mountain. You can put the best pilot behind the wheel, but there's nothing he can do with that amount of time. In other words, this needed turning around a long time ago. That's why I've been a massive fan of Ron Paul and sound money advocates, for which there have been very few available, I'm afraid, that have been able to win an election. And that's why we see what we see here. So down in the dollar and down in the debt simultaneously, that's the seesaw breaking on either sides of its fulcrum. And that's a real problem. That's a real problem, and it's the first time I've seen it in the US, and I fear for everybody it's not the last. We'll have reoccurrences as the confidence and the dawning realization of the event late 2020, when it technically turned for us on the debt markets, and it turned violently, that is a trend change. People don't want debt as a reserve asset. Not anybody's debt, but also they specifically don't want the American debt. But I don't think debt as an asset class anywhere in the world is going to hold values either. So that side isn't entirely American, but it is as the hegemon, the trust is gone in the big guy in the room.
Gold is soaring and silver is watching. It's one of the strangest dislocations in recent memory. Gold has already broken all-time highs, shattering resistance and heading for $3,350. Safe haven flows are pouring in, the dollar's in retreat, and rate cut bets are skyrocketing. It's the perfect storm for precious metals. And yet silver hasn't followed with the same ferocity. The divergence is unmistakable. Normally, silver runs right behind gold, often outperforming it once the rally gains steam. But not this time. Not yet. The traditional correlation has snapped. Gold is acting like the world's ultimate insurance policy, responding instantly to monetary shifts and geopolitical fears. Meanwhile, silver is stuck in a tug of war between two worlds. Its price action reflects confusion, not clarity. And the deeper issue? Institutional bias. Large funds and central banks view gold as the go-to safe haven. Silver, on the other hand, is still seen as a hybrid, a volatile cousin with baggage. It's not just a precious metal, it's an industrial tool. That dual identity is both a gift and a curse. While gold rises on panic, silver's next move demands something more dramatic. It needs not just fear, but full-blown instability. Only then will it break from gold's shadow and reclaim its historical explosiveness.
So, it's a lose-lose. It's a hyperinflated world on a financially over-leveraged system. So that's how you have this almost perfect storm of stock market down, looking very dire for the housing market, lots of refusals. Why? Because banks don't want to originate new debt. They're rejecting 42% of loans. Very bad outlook for the housing market, a crashing bond market, and an increasing rates environment. So the sensitivity is now very high in and around what was once the robust American system. It's no longer seen that way. So it was almost a perfect storm of ugly marks on all asset classes there. And what that means for the only good news for Americans that are gold stackers, of course, is that you've had an absolute surge in gold last week, and we put it up there, and that's what you got. I think it's a little bit overplayed now, and you're getting a little partial technical correction. But if we look at the days, the last 3 days of the week were absolutely monumental and took you through 3,250. That's already the first quarter to the next 1,000. People forget. We were only just getting through. Let's get that high for you to be accurate. 3,245. So not quite 3,250, but the first quarter of the next 1,000 already getting done. You would expect a technical correction after a dip like that and a surge like that, but it also encapsulates the overall volatility that has been introduced into the system, the whiplashing up and down, and the nerves of big money. So there's a very skittish feel to markets generally. And I wouldn't say most people would be giving the Trump administration high marks for the manner in which they've communicated that which they do. They took a little bit of a blustery, aggressive approach, then recanted, and then it's still coming. But, after we think first this time, instead of shoot, aim, fire type story, they kind of have been a little bit all over the shop, and I don't think they've done diplomatically any great favors for themselves or credibility. But to us, in our opinion, this is all part of an orchestrated takedown, and putting on a bit of a Flintstone movie there in terms of diplomacy is potentially even part of the plan, because it's the goal is to implode the financial system, and the hegemon is going to face that outcome. And that's why gold has to be the most best asset for holding in these times, for protection of your reserve asset class, because there is no reserve asset status afforded to debt markets anymore, and all the typical correlations are unwinding because of the sensitivity of the extremity of the over leveraging. And the hypervaluations exist in every market for which leverage was employed. Housing, commercial property, equities on margins, subprime cars, everything. So if you think a car is an asset, it's a current asset. It's not really an asset. It's a depreciating asset. Those things are all going to go down. There'll be repo men and very cheap cars that available for a third of what they were sold for in the not too distant future. It really is reset. People are 4.5 years, 5 years into when the hard reset part has started. And I'm afraid it escalates from here and the volatility increases from here. Most news is bad news for the American economy in terms of deflation. It's actually the hangover phase for something you should have taken a long time ago. But if you're a holder of gold, that's your lifeboat. Absolutely. Yes, well, social unrest and a lot of other things. I mean, I want to make a comment about central banking, because everybody, and especially with your polarized blue versus red, left versus right political environment. You're going to have the Democrats potentially making hay and already preparing for a strong showing maybe in midterms to come on account of what's happening here. But I want to highlight that this is a central banking debt proliferation event, and that it's been on the cards with every political persuasion, with that expansion of the debt that was pushed on both red and blue candidates, Republican and Democrats, since the very beginning. And just to that extent, I brought up the Dow Jones, and I'm going to give you a kind of a prediction and also an illustration of the additional volatility that the Federal Reserve founding had brought to what I would call literally pump and dump schemes, to use a slightly slang street phrase, but this is how it looks.
Silver's identity crisis runs deeper than most realize. While gold thrives purely on financial panic and central bank hoarding, silver has a dual life, and it's that second life that's holding it back. Industrial demand, once seen as a strength, is now a weight. As economies teeter on the edge of contraction, silver's ties to sectors like electronics, renewable energy, and automotive manufacturing are acting as anchors. Investors are torn. Do they buy silver as a safe haven or short it as an industrial casualty? And that indecision is showing up in the price. Unlike gold, which rises when uncertainty reigns, silver needs both financial and industrial confidence to rally in unison. But right now, those signals are at odds. On one hand, long-term demand is booming. EVs, solar panels, and 5G tech are consuming more silver than ever. There's no substitute. The industrial appetite is real. But on the other hand, short-term liquidity conditions are choking speculative momentum. The Fed's policy dance, combined with shaky global growth, means silver is straddling two different narratives, and neither is giving it the full green light. It's the ultimate paradox. The stronger silver's future looks, the more conflicted its present becomes. Until that tension resolves, silver remains stuck, brimming with potential, yet unable to fully commit to its breakout.
So here we have, Elijah, we have the Dow Jones divided by gold ounces. And it's a big one. It's a big long-term one. I'm taking you pre-1900 here just for the hell of it. Because I want to show 1913 was the creation of the Federal Reserve. And if you have a look at that, there's the Federal Reserve creation was literally 1913. They got their feet under the table by 1921, and you had your first roaring 20s boom. That was, very much, what was that classic, The Great Gatsby? It captured the mood, of the great boom era. But you actually had relative stability before that. And given the range of the Dow Jones in gold ounces. Then you had this absolute stretch in the Dow's valuation relative to gold. And then you got, of course, the Great Depression, which everyone's familiar with. And that took you down to about 1.88. I've marked these especially for this presentation with you, after hitting as high as 18.63, by the way. So that means you needed, at that point, 18.63 ounces of gold just to buy one basket where you had the full weighting of every equity in the Dow Jones 30. And then, of course, we had the era between the 30s up to the roaring 60s, where we went from that 1.88 and we went even further than before, 28.47. So what I'm illustrating is the ever greater, as they scaled it, provided more liquidity, more borrowing, more everything, expansionary system, you kept getting ever bigger cyclical pumps. There's your bull market in equities that took you into the 60s. Then you got the stagflation period that was Volcker tightening the rates and actually devaluing the Vietnam War debt that Nixon kind of inherited in the beginning of his presidency that brought you into the 70s. That was down, down, down. You actually fell at your lowest, that less than 1 ounce. We can call it 1 ounce, 0.99, you're there or thereabouts, but technically it's below the level, and it's half what it was the time before, almost half, I would say as well. So you actually could have bought, again, the Dow Jones for essentially one gold coin, an ounce. Then, of course, we had the financialization of everything. After Volcker had cleared the decks, devalued all the debt by pushing rates so high up, of course, rates up, valuations down, devalued that debt. It was a terrible time to own bonds, and even the equities languished for a long, long time. And of course, who flourished during that period? gold did. Now I say we have a hyper version of the original stagflation that came with the Volcker years that we're waiting on. And we've only just started the correction. The peak was .com. Many people don't realize that. We never made the same highs in gold ounces because gold started already to wake up to what was going down. And the peak was almost 45. You would have needed to get 2 tubes of gold ounces if it's a 20 in each, and you would have had to get
Behind
5
silver's
further
hesitation lies a
ounces
pressure
and
cooker
stack them
no
on
one's
top
talking about.
to just
Supply.
buy the 1
For years,
unit.
global silver production has lagged behind surging demand. Mines are depleting, new discoveries are rare, and refining costs are rising. Meanwhile, industrial consumption is accelerating, and investment appetite is creeping higher with every geopolitical jolt. The result? A brewing structural deficit that's been papered over by derivatives and suppressed by institutional short positions. But cracks are starting to show. Physical silver premiums are widening, retail shortages are reappearing. The signals are subtle, but they're building, and fast. The market has been leaning on recycled supply and ETF outflows to keep up appearances, but that shell game is reaching its limit. And once the short sellers lose control, once physical demand overwhelms synthetic supply, the move won't be gradual. It'll be violent. We've seen this movie before. In 1980, and again in 2011, silver broke free with a vengeance, ripping through resistance and multiplying in price while investors scrambled to chase the move. This time, the setup is even tighter. The longer the suppression holds, the more explosive the release. And when it happens, it won't be driven by charts. It'll be driven by desperation.
You bought for 0.99 before. So that's literally 45 times to get in the relationship between. And of course, as you know, we were at around $250 for part of that year, 99, 2000. So gold was the most unloved that it's ever been, and I think that was your high water mark for the definancialization of gold as a reserve asset. And this, trust us, the fiat system, leverage is good, free float, it's all good. .com started the devaluation. You fell from 44.93. We made a localized high at 22.45. The .com bust did not take you all the way. They never let the fire burn out all the rubbish and garbage. It was a controlled descent. It wasn't allowed to finish. They reinflated with a property, and at the peak of 07, 08, you ended up, that's actually not quite correct, 2013, 14, you ended up back up there because gold got slammed a little bit during that period as well. 2013 wasn't a great year. So overall, this is where we're at. We had the CV19 events in 2020, which was over there. And that's when you dipped just that far. You only went that far, 12. And then we're coming over and now we're heading down. So my overall prediction, Elijah, is that this has really barely just begun. Equities are, you've got to wait for the Times or Newsweek article that says equities are dead as an asset class before you next buy a share. You should be all in gold and silver. These people that talk 1%, 3%, I'm like, listen, if you're allowed to, if your house is going to burn and you're allowed to have 5 policies and be paid 5 times out, why only insure it once or 50%? You would certainly over-insure if things are so highly probable of such a collapse. And I think you trade below a single gold ounce for Dow share in the US again. And it'll be lower than the previous time as each one before. And you can see overall, if you look at the structure, and this is what makes this an interesting and big call, this overall structure just shows what central banking and financialization of everything has done. If you think that's stabilization, I've got a bridge to sell you. It is inherently creation of ever larger volatility runs, and you are in this part of what I expect to be a great devaluation to the downside, which will certainly see gold be the preeminent asset, first and foremost. So let me let you unpack that, but that's a big valuation, and there's a lot of social unrest that goes with all of this, and a new financial system I expect that will be rolled out, possibly even before we get to the lows that we're calling.
One of the most reliable signals for silver's breakout used to be interest rates. When real yields fell, silver soared. It was simple, predictable, until now. Today, that relationship is broken. Even as TIPS yields collapse and the Fed pivots toward rate cuts, silver hasn't surged the way it should. Instead, it's hesitated, even pulled back at times, baffling analysts who've long relied on this correlation. So what changed? The short answer, market dynamics. The long answer, fear has shifted forms. In the past, falling real rates meant inflation fears, currency debasement, and a mad dash into hard assets like gold and silver. But now, it means something more complex. It reflects uncertainty, yes, but also fragility. Investors aren't just afraid of inflation anymore. They're afraid of deflation, credit collapse, and liquidity traps. That murky outlook has turned silver's usual tailwinds into fog. Meanwhile, gold has adapted, becoming the safe haven of choice even as the old indicators lose their edge. Silver, however, remains stuck in transition, still tethered to a broken compass. Until a new signal takes over, silver's movements will remain erratic, unpredictable, and frustrating for those expecting the old rules to still apply.
So with regards to the gold-silver ratio, Elijah, I'm not necessarily got the best of news. Gold definitely is your primary investment, and people should go there first and foremost. I have a slight concern about the gold-silver ratio that tells me we are not yet ready for that dominant phase in silver. Yes, we broke 100 over here, and as you mentioned, and yes, it got sold back down a little bit. And I do hear everybody who speaks on fundamentals saying that, you know, we've been in deficit for 5-6 years, we're consuming all of this, etc., etc. But the technical aspects of this, there is a possibility. Remember, it's all possibilities. It's not guarantees when you're talking about the future. But this overall structure that I have here has what we call a little bit of a volatility squeeze on it, and you have broken out to the upside like that. And I fear too many people will go too aggressively long into silver thinking, I was late into the gold move, but I'm going to make up for it by being right on time in silver. And the one concern is if they do have control over a very small market, maybe the gold-silver ratio stretches even beyond it. Because if you looked at the Dow Jones versus divided by gold chart that I had on previously, essentially what I'm saying is each crisis, each pump has been larger in gold ounces. You saw the volatility expansion, the big pink megaphone that I drew on the Dow Jones and gold. Each crisis has been more scaled than the previous one, and each reaction larger. And we still have a large reaction to go. People are going to front run the next stages before they're ready. And that's a concern. And that would mean that potentially the gold-silver ratio, if it's a bigger crisis and it's going to lead to the end of the banks, the great taking, all these people that have made fantastic predictions and done real research, all these aspects, this is going to be even bigger than CV19. Basically, everybody's going to lose their money and get a digital ID and be told, you need to behave, this is what government expects of you, and then you'll get a UBI. And you must do certain things useful. And if that event is to occur, we're actually talking about something that manages to be bigger than the previous crisis. And when I draw this, I highlight that CV19 was of the modern era, you know, the only time that we've really spent any meaningful time above 100. In fact, when we got to 90 here, we sold off. We got to 90 here, we sold off, we sold off, we sold off. And we've just broken it again. And we went above 100. We're now probably just at 100, but
the world is abandoning the dollar, and gold is leading the way. Central banks are hoarding it like never before, snapping up hundreds of tons while quietly offloading U.S. treasuries. And it's not just Western institutions. This wave is coming from the East. Nations aligned against dollar hegemony are stockpiling gold as a direct counter to U.S. financial dominance. It's a de-dollarization strategy hiding in plain sight. But here's where silver's story twists. While gold benefits directly from this geopolitical rebellion, silver remains the outsider, ignored by central banks, untouched by sovereign reserves. It's not part of the monetary reset just yet, and that's precisely what makes its potential so explosive. because as the dollar's global credibility crumbles, gold is laying the groundwork, but silver is still undervalued, still underowned, and still underestimated. When confidence in fiat evaporates entirely, the monetary spotlight won't stay fixed on gold alone. Historically, once the financial system buckles, silver becomes the people's metal, the one asset that retail investors can actually touch, afford, and accumulate en masse. It's gold for the masses. And when that moment comes, the shift into silver will be sudden, overwhelming, and irreversible. Silver isn't late. It's just waiting for the monetary floodgates to open.
The concern I have is we do something like this and we have a real blow-off in relative valuation on account of gold truly is being chased by the insiders and the mega money, and that silver remains much more repressed in that. And we actually have a target generated from this pattern that I'm showing you, and it says you could get to 170 in gold-silver ratio, which would be a new high. Now, I know that's going to cause all sorts of howls of indignation. I'm a silver bull, I love silver, and I buy silver. I've got a beautiful 5-ounce here, right here, and I intend to continue adding to them. I'm just saying, don't be too soon into the pivot phase, because when you're taking a lot of money away from it, it's the small guy buying the silver, it's the big guys buying the gold. The big guys have the money, even when they're crashing systems, they have the money. The oligarchs, the megacorps, the central bankers, they will have, and they will rush into gold because the value is high and the liquidity is high, and it's now a 20 trillion plus, 21, 22 trillion, God knows what it'll be tomorrow, markets. Silver, much, much smaller, less liquid, much more storage space, much more problems and practicality, that actually we see an extension first on the relative value, and people will be moving too soon. Then their money gets taken out of the banks by the great taking or collapse, because we're going to get a bank crisis out of this. You're going to have hedge funds, bank crises, insurance, pension issues. All forms of issues are going to of a structural nature. Municipalities, state-based finances, and national finances, California's finances, everything's going to be coming out, and there's going to be banks involved going, but this is going to be the big one, and we are in it. You're going to have a lull, things will hyper-normalize for a while, they'll rally, and then you're going to get Mark II and Mark III. This is the end, and the 2020 call was the beginning, the firing of the gun of the debt-based collapse. Do not buy so much silver at these prices that you don't have other wealth, you don't have other means, so that you become a forced seller if the banks go down and take your money. If everything else you have of digital wealth disappears, if you haven't paid off your house, lots of things like that. Before you go absolutely, hammer to the metal on silver accumulation, get all debt instruments out of your life. Reduce your exposure to inflation rates. And that's what I'm going to suggest to everyone on a non-advisory basis, but it's what I've done. I don't want to see you run into trouble and become a forced seller of your silver just before it moons. There will be a flush out to the downside. There will be events that will be so big there's no one crazy enough to predict them, is what I'm saying. And then you'll be a forced seller just to eat, pay rent, do various things. Do not allow that to happen. Get the controlled demolition financial instrument, which is interest rates and debt, out of your life first. So chase gold for now and get the debt out before you go hammer to the metal with just silver stacking. And there could be an extension in the gold-silver ratio. Technically, we're moving up and we're moving slowly. This was a melt-up, Elijah. And then it's over. Melt-ups end very quickly. This is a decent, steady break of a key level for us. And this can go on for quite a while. You see it here. This is low vol walkout. It just keeps grinding up. There's going to be stages to what we are going.
The tremors building in Asia's silver market are no accident. They're the early signs of a global eruption. In China, retail investors are piling in, speculative bets are growing, and physical premiums remain stubbornly high. The Shanghai-London price gap, once a quiet signal, is now flashing bright red. But this isn't the kind of steady institutional demand seen in gold. It's reactive, emotional, and increasingly erratic. Volatility is the name of the game. Silver prices in Shanghai have spiked over 2% overnight on multiple occasions, only to retreat within days. Derivatives volume is surging, but so is uncertainty. Speculators are jumping in ahead of what they believe will be silver's breakout moment, but they're also jumpy, pulling back at the first sign of resistance. This creates a whipsaw effect, where silver's trajectory becomes less about fundamentals and more about crowd psychology. It's dangerous, but also revealing. Because beneath all that noise lies a truth the market hasn't fully priced in. Silver is gaining attention. The masses may still be asleep in the West, but in Asia, silver is becoming the focal point of a new financial narrative. And as this speculative fire spreads, it's only a matter of time before it ignites something far more permanent. A global silver rush that begins not with Wall Street, but with retail panic and Eastern conviction.
About to go through, and I just put out a warning there on gold-silver ratio. Be careful. You'll get your chance on silver. Gold will keep running. It's quite possible silver tops out at 50, the 45-50 mark. If you were to have, say, a 200, I'm not saying it's going to 200, but let's just, for simplicity of mathematics, say 200, which is not too far off 175. You could be at $50 silver, and you could be at 10,000 gold. I've done it at the 170, 175 range, and you're looking at about 8,500 on gold to 9,750. And silver at $50. You know, that's a big stretch. Eventually, the more it stretches, the more it will correct later, and that's when you get paid. But you need to be able to stay in the game to get paid. Otherwise, you get flushed out, and guess who's there to buy your silver off you at the lows at $50 before it goes to $350, $500, or anything crazy. By the way, that won't be the same dollar anymore in most senses. That's literally what I see coming, and it's quite a warning message there for everyone, just to take it easy. This is the big one.
Now, before we let you go here, just to kind of push back on this, and I'd like to get your perspective, because when we saw that spike during COVID-19, that was kind of the bottom, right, for both gold and silver. It's when they were crashing. And then when we saw that spike low also back in 2011, it was when silver was making almost, a new high. It was getting close to that $50, and gold was also running up as well. So it seems like we see the spike lows in the gold-silver ratio when we're seeing them gold and silver increase and we're seeing the spike highs when they're both decreasing. But it sounds like you're saying you're expecting gold to increase. So it seems like in that kind of crisis scenario, when people are piling into the precious metals, silver would outperform, not the reverse. But your take on that?
Yeah. So again, we're in a crisis where the average consumer is getting wrecked. I think we've been in a recession since we met the criteria for a recession. We've continued to say that. And a lot of that unemployment was DEI jobs, status jobs, or to contractors to government. So essentially, this is a very hard time for the consumer, the ordinary man, the man in the street, the middle class, the working class, and all points in between. It's not a hard time for the billionaire class because their assets have been hypervalued, and inflation is destroying the debt that they used to borrow it, and they got great rates on it as well. So what tends to happen is gold, the secret's out. The debt market is over. The secret's out now. It wasn't like that in CV19. That's why it was all on the capitulation that you had the extreme low in silver. I think it was spot was 11, although you could only buy it for 14. The premium stretched over here. And gold, of course, had a short pullback. But then gold very quickly turned and made the new high, while silver had a lot longer journey back from the $11. So this is different. People are already buying gold, and gold's not going to be meaningfully sold. And we're going into an ever-escalating crisis. We're yet to have the CV19 blow-off event, is what I'm saying. This crisis is multi-pronged, which could even end up in a hot war. It's certainly a financial war.
Everything is building toward one final event, one catalyst that will rip the mask off the global economy and thrust silver into the spotlight. Call it the financial Armageddon. It could be a sovereign debt crisis, a major bank collapse, or the total seizure of the bond market. It doesn't matter what the trigger is. What matters is what follows. Liquidity dries up, panic sets in, trust vanishes overnight. That's when silver moves. Not like a steady investment, but like a force of nature. Gold will continue its climb, of course, but silver will go vertical. Because when the entire system is questioned, people don't want paper promises. They want tangible assets. And silver, with its dual identity and decades of suppressed value, becomes the escape hatch. In the fog of financial war, silver's volatility transforms from a weakness into a weapon. It becomes the fastest horse, the most reactive asset, the ultimate bet on collapse. And all the hesitation, all the lag, all the strange disconnections we've seen, they'll vanish the moment the crisis hits. That's when silver breaks free, not because the market says it's time, but because survival demands it.
It's certainly people sizing each other up for a financial war. That's what the tariffs are. America's saying, we can't pay our bills. We need someone else to pay. And hey, we've done a lot for you. You know, Europe, you must spend 350 billion. You've got a trade surplus. You must buy all our energy. You can't buy from anywhere else. And all sorts of quite outlandish, draconian bully boy tactics. But that's desperation. This comes, I'm afraid I have to paraphrase US currently now, like an old steroided out bodybuilder that's in his mid-50s hanging out at the pub and a bit drunk and wanting to take on all comers and swinging for the bleachers and telling everybody to shut up. It's not a good place. This is out of destruction, loss of crown, of their crown. And essentially gold has already got the script. And debt has already got the script. But we've yet to have the contagion moment where the debt goes no bid. And that's yet to happen. We just had a week where we had one moment where the seesaw breaks. That's not the crisis. That's the beginning of the first symptom like that. That's the Parkinson's in the bodybuilder. He starts to not know where he put anything down. It's getting more aggressive for no reason. But that's not the event where he dies. That's the beginning of the clear symptoms. So we have yet to have the CV19 final explosive event. So this is going to be a multi-stage collapse. And we're really, the first 5 years in, something that's probably going to go from quite a benign period into a very lot of decades happening in weeks. And it's going to be very volatile the next 2 or 3 years. And I wouldn't be surprised we're staring at a different financial system and some very dark truths about how empty the vault is in the US in terms of welfare, Medicaid, ability to pay. Boomers that haven't secured their retirement and don't have some physical assets owned in full could end up, being on all forms of very menial welfare. I don't know. I don't want to turn this into who can tell the darkest story about the future. I'm already deeply down that path. But this is a financial collapse of the entire system. And
Silver's breakout won't be gradual. It'll be a detonation. For years, the metal has been shackled by paper manipulation, industrial distractions, and a market obsessed with gold. But once the final domino falls, once the last illusion of dollar stability collapses, silver won't just catch up. It'll leap. Every suppressed ounce will fight back. Every forgotten investor will rush in. Every warning ignored will echo in the stampede. And that's the moment silver hits escape velocity. Gold may be the alarm bell, but silver is the reaction. It's the people's hedge, the overlooked powerhouse, the fuse waiting to ignite. So if you've been watching from the sidelines, unsure when to act, understand this. When financial Armageddon hits, there won't be time to wait. Silver's window doesn't stay open. It shatters. So don't miss what could be the most violent revaluation of a precious metal in modern history. If you found value in this discussion, make sure to subscribe so you stay ahead of the next big move. And remember, this is not financial advice. Speak to a professional before making any investment decisions.